It was the bubble that ended in the tech wreck. The speculators got carried away and created the era of what Alan Greenspan famously called irrational exuberance, where enormous prices were paid for what were often little more than ideas. And it's still easy to get attracted to good ideas today because the world is changing, and it's changing very quickly. Many of the participants are new, and in the early stages, picking the winners is still a lottery. But we do know that market share matters. We now Google, we don't Yahoo or AOL, we use Windows or Apple, and we get our stuff on eBay. Grabbing the space requires good management and perhaps just a little bit of luck, but once you've got it, you've got it. You don't have to get it again, but you do have to defend it, and you have to build on it. And while most of the action is overseas, we do have some local businesses that are worthy of consideration, especially those that are capturing the rivers of gold that used to pay for newspapers, the classified advertising. Seek isn't a small company by Australian standards. It's actually the world's largest online employment classifieds business, with a market capitalisation in excess of $2 billion. Earnings dropped back a little in the wake of the financial crisis, but they've risen steeply since listing and are forecast to continue doing so. There are other businesses to keep an eye on too. Car Sales listed in 2009 and it's made an impressive start. And realestate.com has been listed for a while. They've captured a lot of market share and the earnings growth has been good. The case for investing is diminished a little by the fact that 60% is owned by News Corp and they dominate the decision making, and the low free float keeps them out of the main index. Our largest technology company is still Telstra, and the share performance has been extraordinary in recent times. Mind you, it was coming off a low base and it's no longer hugely oversold. We're not falling for retrospection here and chasing past gains. While Telstra hasn't really increased its earnings since they floated, the business model's changing. They're ditching their old technology, they've got plenty of cash, and they'll have plenty more from the government as a result of the national broadband network. Earnings growth is now anticipated, and the dividend rate that's been stuck at the same level for 6 years is expected to start rising. And even if the promised growth becomes illusory, the risk of investing is mitigated by the still attractive 6.5% fully franked dividend. Allowing for franking credits, this equates to a pre-tax yield of 9%, so you'll be earning good income if nothing else.